Where to invest in emerging markets over the next decade? For over a decade, emerging markets, EMs, have been full of promise and disappointment. Year after year, investors have waited for the powerful growth trends of the past that drove developing markets from Mexico to Malaysia to reassert themselves. But looking back to assess the future is a questionable strategy. Instead, we think investors should focus on the changing dynamics in EM economies and markets that could reignite returns in the years ahead. Capturing this potential requires specialized research skills because EM companies and markets still march to a different beat than their developed market (DM) peers. From boom to bust, 2 eras in 20 years. It's easy to understand why expectations of EM are anchored to the past. From 2001 to 2010, as historic change swept through the developing world, the MSCI Emerging Markets Index posted supercharged annualized returns of 15.9%, outpacing DM stocks by a wide margin. Yet since 2011, EM equities have advanced by a paltry 0.9% annualized. The EM bull market of 2001 to 2010 was fueled by unique circumstances. China joined the World Trade Organization in 2001, increasing its share of world exports and accelerating globalization. As this played out, China made massive investments in fixed assets and real estate, unleashing a commodities supercycle. From 2000 to 2010, China's GDP grew by 10.6% on average, boosting global economic activity while enriching commodity-producing EM countries and supporting their currencies. Inside China, a wave of unbridled commercialism reshaped the business landscape in a colossal cultural shift that generated handsome payoffs for astute investors. Since 2011, the EM tables have turned. Many EM economies suffered a hangover from the boom, caused by uncompetitive currencies and a failure to reform, particularly among commodity-exporting countries. Since 2014, the US dollar strengthened, eroding US dollar earnings per share growth for EM companies. Commodity prices eased and geopolitical concerns intensified, from US-China trade wars to Russia's invasion of Ukraine, while the COVID-19 pandemic added new challenges. Meanwhile, in China, annual GDP growth slowed to 6.6% from 2011 to 2022 and is expected to decelerate to about 4.5% in the coming years, according to consensus estimates. Under President Xi Jinping, who came to power in 2013, China began to pursue a more assertive foreign policy and domestic economic reforms. More recently, China's government has tempered support for entrepreneurialism in favor of a broader agenda focused on social equality. Against this backdrop, EM corporate earnings suffered a lost decade display, which suppressed equity returns. What next? 4 trends could revive EM fortunes. Will the next decade be as bleak for EM investors? We don't think so. Our research shows that over the last 4 decades, EM stocks delivered prolonged periods of returns superior to those of DM peers, which could materialize again after a sustained period of underperformance. Still, a potential recovery of EM stocks will be propelled by a very different set of forces. 4 key trends will define the next EM era. Innovation will be the new impetus for growth. Technology and innovation are the new engines for EM growth. They help countries leapfrog into competitive positions. Empower consumers with digital capabilities and enable companies to participate in a global innovation bonanza, no matter where they are domiciled. EM countries are leapfrogging DM countries in many areas. For example, the adoption of electric vehicles, EVs, in China reached 27% in 2021, more than 4 times the rate in the US. In mobile payments, China is a global trendsetter. Elsewhere in Asia, digital wallets accounted for about 30% of all retail point-of-sale transactions in 2022, about 3 times the European rate, according to the FIS Global Payments Report. EM companies are active participants in the global technology revolution. Many components that enable AI are manufactured in EM countries. China is home to innovative companies that support global efforts to combat climate change. Developing countries have doubled their share of internationally filed patents since 2000 to 23%. Reshoring will spread across developing countries. Over the past 2 decades, China cemented its role as factory to the world for countless global companies. But wages in China have risen much faster than wages in other EMs, and COVID-19 exposed the risks of heavily concentrating supply chains in one country. As a result, Companies are reconfiguring supply chains and are more willing to pay up and bring manufacturing closer to home to prevent future disruptions. Countries are essential to the shifting supply chain landscape, in our view. Vietnam's educated population is rushing to fill jobs in the electronics industry, and the country's share of electronics exports has surged nearly fivefold, to 5.7%, over the past decade, according to World Trade Organization data. Bangladesh has increased its exports of ready-made garments from $17.9 billion in 2011 to $42.6 billion in 2022. Mexico is grabbing the market share of vehicle assembly, particularly in EVs. The country is expected to produce more than 221,000 EVs in 2023, a 179% increase from last year. Mexico's proximity to the U.S. and attractive labor costs have enabled it to overtake China as a key manufacturing hub for the U.S. market. As a result, capital investment in Mexico has been steadily increasing since 2021. In India, newly crowned the world's most populous nation, large domestic investment in infrastructure is bolstering manufacturing and attracting foreign investment. Samsung already has operations in India and continues to invest. Taiwan-based Foxconn Electronics, an Apple supplier, is planning a $200 million facility for producing AirPods in India, marking a big vote of confidence in the country's manufacturing capabilities. That investment illustrates how globalization is changing. Investors who can identify the next big reshoring destinations and industries will be able to capture attractive opportunities as the map of global manufacturing is redrawn. China's Common Prosperity Policy redefines growth. As China's population has become richer in recent years, the government has become more sensitive to a widening socioeconomic gap. In August 2021, President Xi Jinping said that common prosperity, rather than being egalitarian or having only a few people prosperous, referred to affluence shared by everyone. Xi seeks to increase per capita income and to reduce inequality across income groups and regions. The agenda covers many areas, from more balanced development to boosting productivity, income and infrastructure. As part of these efforts, China has taken regulatory action in recent years against certain industries. These moves rattled markets and, for some investors, undermined confidence in investing in China, as regulatory moves are unpredictable. We think that's the wrong conclusion. In our view, regulatory uncertainty can be mitigated with a better understanding of the interplay between the government and private sector in China. Certain types of Chinese companies will benefit from the policy priorities. These include companies that can navigate the commercial and ideological priorities, and businesses aligned with the government's agenda. Companies that cater to less wealthy customers may also have an advantage. Instead of foregoing China's significant return potential, we think investors should develop a strategy that aims to reduce regulatory risk and identify opportunities in a growing economy that is forecast to become the world's largest by 2035. If you find this video useful, don't forget to like and subscribe to our channel.